Joining us to talk about the market day, Barry Knapp from Ironsides Macroeconomics and Keith Bliss from IQ Capital still with us. Let's begin with Mike Santoli. It feels great to end the day, the year, the decade on a positive note, but it's really been an amazing year for investors.
And one really of kind of relief. I think at the start of the year that the bad economic scenarios that maybe were getting priced in at the end of 2018 did not come to pass. And then what we got was Federal Reserve cutting rates 3 times without really much cost in terms of economic growth. So basically, financial conditions got much more accommodating and looser. At the same time, profit margins basically held flat at record levels, and the U.S. consumer did fine. So I do think all that together meant, bull market acting like a bull market. And we expanded valuations because it seemed like a recession was not anywhere close, and credit markets have been really underwriting this entire move.
Barry, in the short term, you think this positivity can continue?
I do. There's 3 tailwinds. We have this tendency to get to the end of the year and think, okay, well, what happens next year, and figure it's going to be different. And for sure it will. This is not going to be an echo of 1988 where we spend the whole year recovering from the crash of 87 as we did. But the way I would think about it for the first 4 months or so of the year is that we're in the midst of the recovery from a global manufacturing and export recession. So that positive dynamic as those numbers get better coming out of places like China, even Germany perhaps, will be a positive macroeconomic catalyst. The next is obviously that the Fed is going to continue with QE4, which is clearly loosened financial conditions. You guys have been talking about the weakness of the dollar. The curve is steepened considerably, 2s, 10s, or any of the other measures have really gone from deeply inverted to strongly actually upwardly sloping. And the final piece is just that whole question about the consumer and the fact that we actually are getting the best real wage growth, that is wages less inflation of the entire business cycle, with the savings rate high and the consumer having deleveraged through this entire business cycle. There's just no scope for any weakening of consumption. So, as the trade tensions ease and capital spending recovers as well, you've just got this window that should last till about April. And I'm real specific about that April, sort of May timeframe, because like 2011 after the launch of QE2, after they launched sovereign QE in Europe, you get to this point where you start looking at earnings, the markets have had a huge move, and these programs are just not that economically efficacious. And so earnings will I expect an earnings recovery, to be clear, but they won't be as strong as stock prices reflect, and we'll be staring down the barrel of another Fed policy normalization related correction when they want to end the $60 billion of Treasury bill purchases per month.